Hello and a warm welcome to the Open Treasury podcast, your go-to source for the latest news and analysis in corporate cash and treasury management. This show is brought to you by CTMFile.com and the Treasury News Network, where treasury professionals learn and share the information that matters most. I am your host Pushpendra Mehta. Joining me today is Paul Galloway, Senior Director, Advisory Services at Strategic Treasurer. Welcome back, Paul, to another episode of the Open Treasury podcast.
Hey Push, thanks for having me again. I always enjoy this.
We truly appreciate your time and insights as we explore vital topics shaping the landscape of corporate treasury management and beyond. In today's edition, we shall discuss two stories in detail. First, three critical aspects facing treasurers, CFOs, and CEOs now and beyond. And second, global banks set to use Swift for testing live digital asset transactions from 2025. With regard to the first story, the three critical aspects facing treasurers, CFOs, and CEOs now and beyond, we will be discussing the three vital aspects as separate topics in today's podcast discussion. The three critical aspects are: first, record high US national debt, a ticking time bomb likely to spark a debt crisis. Second, key focus areas for treasury and finance in the coming years: technology, payments, payment security, and risk management. And third, Fed cut rates, yet corporate America faces higher interest expenses. Our audience can watch videos on the CTM File YouTube channel and explore insightful articles, industry roundups, and interviews on ctmfile.com either by visiting the website or by following the links provided in our show notes. Let's commence today's discussion with the first critical aspect facing treasurers, finance chiefs, and CEOs now and beyond. This vital aspect is about record high US national debt that is likely to spark a debt crisis. As multinational corporations and their treasurers, CFOs, and CEOs navigate economic and business uncertainty, they must contend with the ticking US national debt time bomb. The national debt of the United States hit a new record in July 2024. According to the US Department of the Treasury, the gross federal debt surpassed US $35 trillion for the first time in history. The US Treasury Department defines national debt as the amount of money the federal government has borrowed to cover the outstanding balance of expenses incurred over time. In essence, this debt represents the full amount of outstanding borrowing by the US federal government over the course of the nation's history to pay for or cover its operating expenses. Moreover, data from the US Bureau of Economic Analysis, or BEA, shows that as of September 2023, the US debt of $33.17 trillion exceeded the fiscal year 2023 average GDP of $26.97 trillion. This resulted in a debt-to-GDP ratio of 123%. Generally, a higher debt-to-GDP ratio indicates a government will have greater difficulty in repaying its debt, as indicated by the BEA. In June, the Non-Partisan Congressional Budget Office reported that U.S. federal debt will continue to climb and is poised to reach $56.9 trillion by 2034 as rising government spending and interest expenses outpace tax receipts. As of August 2024, data from the U.S. Treasury Department reveals that it costs $1.4049 trillion to maintain the debt, which is 17% of the total federal spending in fiscal year 2024. The burgeoning US government debt is a ticking fiscal time bomb that now represents one of the greatest threats to its long-term economic growth and financial stability, and is likely to spark a debt crisis that might not unfold in 2025, but it will arise in the future as the US continues its reliance on debts and deficits. Paul, you are an experienced treasury professional with an understanding of economic issues. Does the rising debt levels include surging interest payments on federal government debt and the high debt to GDP ratio worry you, particularly from a corporate treasury perspective? And if so, do you think more treasurers should pay attention to America's mounting debt and prepare for a potential crisis?
There's a lot to unpack there for sure. When I think about our growth relative to the federal spending, which continues to be quite significant, it does raise some concerns that we potentially could be outpacing ourselves, and if we continue to do it, it could become a significant issue, a problem. If we have trouble repaying our debts, making interest payments or paying the debt, principal itself, that could create more economic pressure on America writ large, impact the U.S. in terms of the U.S. dollar being a reserve currency, could impact taxes to help pay the federal spending that's occurring. And this is assuming that we do nothing. We just continue to do what we're doing, the things I'm talking about. And so it's going to create more and more challenges for growth. And if growth starts falling further behind and we aren't taking care of the debt, we could exacerbate the problem, which means now you look at where we're at today at 120 plus percent of GDP, and it could get significantly larger. I think in this article it pointed out by 2034, anticipating at this pace somewhere around 59 trillion in debt. And that's a significant number. So if we're at 35 today and we go 10 years forward and we're going to almost double what we are currently at, that's a lot. That seems like something that we need to pay attention to. If I'm a treasurer, I have to pay attention to what's going on. I have to pay attention to it from a financing standpoint, impact on currency, FX, what those values are, what that means to me in terms of costs, my ability to access capital or cash when and where needed. So my liquidity or capital management, what I do there becomes more important. Forecasting is going to be more important to me, making sure that I'm able to forecast what I think is going to happen. That means that treasurers are going to have to think beyond just the traditional things that impact Treasury. So now they got to figure out, okay, from a geopolitical standpoint, what's going on out there? How could that impact me? So as a treasurer, it would be important for me to do a variety of forecasts, scenario, perhaps sensitivities to certain indicators out there in the markets. When I think about our spending, some of the issues I have, I'm kind of torn a little bit, Push, because I think in some respects the government should shut down to get them to open their eyes so that they could step back and say, what can we do better? We can't spend our way out of it. That's just going to cause more inflation, and it's going to continue to have an increase in the amount of debt outstanding. So we can get to that 59 trillion quicker. Also, if we aren't prudent in the way we spend our money, we're not doing a service to the American people writ large either. Yeah, I'm not saying that we don't have worthy programs out there. We do. Taxing individuals and corporations more, I don't think is necessarily the answer either. So, we've got to find some kind of balance. So I'd like to see our leaders take a step back and look at this from the lens of maybe we shouldn't continue to do what we're doing because this is how it could impact America. I don't think we're seeing that. We're temporarily funding the government on a short-term basis, then turning around and coming back and readdressing it again with another spending package that just has all kinds of stuff in it. I can't even imagine trying to read through the hundreds and hundreds of pages that are in these economic packages that get passed and truly understanding what it all means. I don't know if anyone really can. So I do have concerns about what we see today. So as a treasurer, you need to pay attention. You need to make sure that you're positioning your organization to withstand stresses, because we may have stress out there. We may have things that impact a company's ability to access capital and to make their own payments on outstanding debt or credit that they have, or be able to continue to grow their business and thrive. So I think this is really an important thing for treasurers to keep an eye on, and for our government itself to step back and reassess what's going on, because it feels like they just continue to kick the can down the road and they're not addressing the problem. I think they got to address it.
Well, I couldn't agree more. That was a really insightful perspective, Paul. Thank you for shedding light on this crucial aspect. Next up, let's delve into the second critical area facing treasurers, CFOs, and CEOs now and beyond. This involves the key focus areas for treasury and finance in the coming years. Besides cash and liquidity management, technology, payments, payment security, and risk management will be top priorities for corporate treasurers and finance leaders in the coming years. In response to ongoing global financial uncertainty and heightened global tensions, corporate treasuries are expected to speed up their digital transformation by harnessing emerging technologies to strengthen cash flow visibility and liquidity forecasting, thereby enhancing operational efficiency, mitigating risks, and bolstering cybersecurity. The importance of payments is also on the rise within corporate finance and treasury worldwide, as they enable the efficient transfer of funds both domestically and internationally. The rapid growth of the payment sector can be attributed to several crucial factors: advancements in payments technologies, the advent of innovative payment methods, the increasing adoption of the ISO 20022 financial messaging standard by corporations and banks, and the significant growth in digital payments, cross border payments, and real time payments. The proliferation of payments and breakthroughs in payments technology has unlocked fresh possibilities for perpetrating payments fraud, which will place a substantial strain on organizations given that global payment fraud is projected to continue its upward climb, with estimates suggesting it could cost $40.62 billion by 2027. Risk management will also be a significant time consumer for treasurers, CFOs, and CEOs in the coming years, as they find themselves dedicating more hours to addressing various types of risks than they have in the recent past. Paul, in light of what I have just summarized, do you believe that besides cash and liquidity management, the key focus areas for treasury in the coming years will be technology, payments, payment security, and risk management? Or do you think there are other priorities to consider?
I think these are definitely areas that treasurers need to be focused on for sure. When it comes to the technology that's out there, the one thing that we're seeing is that while data is growing at a fast pace, the good thing is that technology is outpacing data in terms of growth capabilities and the ability to handle data. So technology out there is improving, and not only just for handling data, but for handling payments. And so we're seeing advances in payment technology out there. And some areas of the world are adopting at a faster rate than other areas. However, it doesn't mean that there isn't a willingness out there to adopt new technologies, because we're seeing more and more ways to pay, whether you're an individual or a company, with real-time payments, with faster payments, with the use of technology, your phone, your watch, cards, no cards, different platforms. You can borrow and transact business from companies that are not banks, but they can facilitate or act like a bank even though they're not a bank. We're seeing tokenized payments out there. We're seeing different ways to pay that go beyond just a fiat currency. So whether you're talking about the DeFi arena, there is a lot of options out there with these different coins that represent value and that are being traded. And when it comes to understanding those and utilizing those, it's upon corporations to understand what it means from a compliance and risk standpoint. And so faster payments are instant payments or real time. These types of payments means that you got to have better controls, because if something goes wrong, you need to be able to react quicker, because your loss or potential loss from a financial perspective has sped up and the ability to recover it has shortened. So you have to be able to react and detect quicker. So payment security is becoming more and more of a high priority. And I say that from a perspective of the fraudsters using technology against corporations to steal money. We're seeing that with the use of AI, in particular deep fake that happened earlier this year in Hong Kong. $25.5 million went out the door through a Zoom deep fake. It seemed like it was their leadership that the Treasury team was talking to, and in fact it wasn't. And it was too late. That money got sent out the door to 15 different banks. They lost that. And it seemed credible. And AI technology is getting better. And that wasn't like really good technology. It's even better now, since that happened earlier this year. And it's harder to detect because the movements that you're seeing in the fake videos are getting better. So it's kind of scary. You need to be on top of what's going on from a fraud perspective. So payment security, we're having more and more clients coming to us requesting assessments. And so we do payment security assessments. We do payment security penetration testing. We also do payment security training. These are things that treasurers and corporations are starting to take advantage of. And we're getting a lot of inquiries and a lot of business in that area. And for a good reason. There is more risk out there. So risk management has become more and more important. So companies have to really step up and utilize the technology that's available out there to help them fight against fraud, to help protect them. They need to do assessments. They need to understand where the risks are. Human risk, system risk, risk from inside the organization, risk from outside the organization. Being able to assess that and understand how to mitigate, how to protect corporate treasure is super important. And penetration testing also helps understand where the weaknesses are in the systems and processes, so that you can shore that up and ensure that there is less risk, or you're more protected against fraud. As well as training. Training is super important. Being able to train your employees, have a risk mitigation plan in place. So if something does go wrong, you detect something, you take action. You know how to take that action. You take it swiftly. So these are all things that I think are more and more important as a treasurer to get your arms around. When it comes to thinking about the use of newer technology in terms of payments, the move to ISO 2022 financial institutions, corporations for making payments actually helps having a standardized process. The more standardized you get, you're able to detect anomalies a lot better. And what we're seeing from organizations out there is they're taking steps to continue to advance payment rails, which means use of technology and being up to snuff in terms of payment fraud is going to be more and more important, because we have more coming out in the future, which means there's more risk anytime you bring out something new. The fraudsters are going to look for a way to take advantage of the new technology and try to steal money from corporations.
Well, that's an intriguing take on the subject, Paul. Let's shift the discussion to the third critical aspect facing treasurers, finance chiefs, and CEOs now and the days ahead. This pertains to the US Federal Reserve, the Fed, lowering interest rates, yet corporate America is likely to face higher interest expenses. Last month, the Fed decreased the federal funds rate by half a percentage point to a range between 4.75% and 5%. This marked the US central bank's first interest rate cut in 4 years, with further rate reductions expected later this year and into 2025. While lower interest rates will likely ease borrowing costs for consumers, corporate America is likely to experience a rise in interest expenses. Why is this the case? A recent article in The Economist suggests that the most significant reason corporate America's interest rate costs are poised to increase is the behavior of finance directors. American companies borrowed heavily on longer term deals in 2020 and 2021 after the Fed had cut rates and before the tightening cycle got underway. Low rates were locked in and firms were relatively insulated from the subsequent tightening. Indeed, the unusually strong performance of the S&P 500 index of large companies, which has risen by 24% since the Fed first raised interest rates, may in part be explained by this protection. However, The Economist explains that the tide is now turning as locked-in deals begin to expire. Fixed-rate loans usually span 3 to 5 years, and over $2.5 trillion of fixed-term corporate loans are slated for refinancing before the end of 2027. Of this amount, $700 billion is due in 2025, followed by more than $1 trillion in 2026, according to the article. The industries most exposed to refinancing risk are those that benefited greatly from cheap fixed rate deals shortly after the onset of the COVID-19 pandemic, particularly manufacturers. The Economist further warns that the pain may be considerable. Bonds of the typical American non-financial triple B rated firms due to expire in 2025 have a median interest rate of just 3.8%. On current trends, they will probably attract a rate of closer to 6% when reissued. Interest costs will rise just as interest received falls. Paul, considering what I've just outlined, do you believe that corporate America is likely to experience a rise in interest expenses despite further rate reductions expected this year and in 2025? Or do you believe the outcome will be different?
Yeah, push. So when I think about interest costs, we had a period where we got really lower interest rates when COVID-19 was going on. So there was a huge drop in rates. Corporations took advantage of that and bolstered their balance sheets for two reasons. One, it was low cost financing, and two, the pandemic was happening, which had a significant impact on all corporations. So they wanted to bolster the balance sheet to make sure that they had capital for any potential risks that were out there, try and mitigate those, and make sure they could keep the organization moving forward in light of what was going on in the pandemic. So, when they financed the balance sheet, they financed it with midterm, 5-year so issuances at a fixed rate. And so, as you know, with a fixed rate, that means your interest payments don't change over that period. And so, as that continues to roll off, I think they're going to actually replace that with more floating rate or variable rate financing, especially if you think the Fed's going to continue to lower rates. So they'll take advantage of it and try to mitigate that because, they're going to lose out on yield as well as they reinvest. So they have refinancing risk here, they have reinvestment risk. So as yields go down, especially on the shorter end of things, they're going to get less return. In particular, this will impact cash. From a longer term investment standpoint, they're going to try to go out longer to maintain a higher yield on the investments as interest rates go down. So I suspect a lot of corporations are going to take advantage of more variable rate financing, and they'll look to ride that interest rate down as the Fed makes movements. And so that will help offset some of that pain. They'll go longer on their investments and they'll go variable on their financing. That may not be the case for all of them, but that's what I suspect that they're going to do, which will help. So do I think that a potential for interest rate expenses to increase? 100%, because when they finance their balance sheet, they finance at a very low rate. It's going to be much higher this next go around. So there will be an increase in interest rates. There's no avoiding that on the front end, even if they go with variable. If they go with fixed, they're going to lock themselves into a longer period at a higher rate. They may go shorter on their refinancing at a fixed level, so they could go fixed, but go shorter duration and accept what that fixed rate is for a couple year period maybe. Maybe they only go 1 or 2 years and then refinance again. It depends on their banking partners. If the banking partners are willing to do that, you got to have the partners in place to be able to go shorter. So they may do that, but most likely I think they're going to go to variable rate and go longer on their investments so that they can get higher yield. Short-term cash is going to be what the short-term cash is. You got to have liquidity. You got to have that component. For anybody that's involved in managing liquidity or capital management from treasury perspective, I think you'll see them try to ensure that they get the right type of facility in place to take advantage of rates as they drop. So perhaps you see revolvers or lines of credit that are floating versus fixed too. So I think they'll try to manage on the short end as well, which would make sense to me.
Well, thank you, Paul, for the discerning viewpoint. Let's now turn our attention to the next story, which is about global banks set to use Swift for testing live digital asset transactions from 2025. Central and commercial banks will be able to use the Swift network to carry out trial transactions of digital currencies and assets in expansive pilots that seek to demonstrate the cooperative's ability to facilitate the flow of all kinds of value between more than 4 billion accounts across 200 countries and territories. Swift has already successfully demonstrated that it can transfer tokenized value across public and private blockchains, interlink central bank digital currencies globally, and integrate multiple digit asset and cash networks. The new trials will explore how Swift can provide its community of financial institutions with a single window of access to multiple digit asset classes and currencies, paving the way for their seamless integration into the wider financial system. Initial use cases will focus on payments, foreign exchange, securities, and trade to enable multi-ledger delivery versus payment or DVP and payment versus payment or PVP transactions. Paul, the rapid growth of unconnected platforms and technologies has led to an increasingly fragmented or splintered payments landscape. Do you think Swift's trials will interlink these disparate networks as well as existing fiat currencies to enable seamless transactions of digital assets and currencies alongside traditional forms of value?
Yeah, Push, I see that we're definitely going to move this direction. Swift's been working on this for a little while now. I think we talked about them running the cross-border payments tests and the tokenized digital payments. I think this is the future. This is the direction that I think we're going to see global platforms go, especially when you have a global platform like Swift doing these tests. This is important, I think, for payments writ large across the globe. And the fact that they're having success doing this, I think, is really important. As a treasurer, you want to pay attention to this. We know the challenges with cross-border payments to begin with, right? There are challenges there. And if this being successful like it is, I think that we're going to see a move to this type of payment platform, and it could be at a significantly fast pace for adoption. There's always going to be outliers, areas that will adopt quicker than others. But I think this is a positive thing moving forward. The other aspect is around trade. And so we think about foreign currency, securities, and other trade with DVP, delivery versus payment, or PVP. These types of transactions, there's a lot of these transactions going on every day, lots of them. To smooth that out with a platform like this, I think is really a positive step forward. Couple that with being able to make cross-border payments easier. And then when we think about central banks going to a tokenized form of currency, we're going to see more countries go that direction. Perhaps not in the U.S. real soon, but I think at some point the U.S. will probably adopt that. I still don't see fiat currency going away. There are people out there that just like people that like checks, some people like fiat currency. So it's not going to go away. So I think they'll move in tandem or they'll work in parallel. And corporations and individuals will choose their path for making payments. It all has value. And if the value is indistinguishable, then it's a matter of choosing the payment rail or system or platform that you're most comfortable with. Some people are more comfortable with an electronic platform, some people are not. And that's just the way it is. That's why we have the variety. That's another reason why checks don't go away. Personally, I don't like checks. I don't like writing them. I like doing the electronic thing. That's me. But there's lots of people out there that like writing checks and would rather handle checks and paper currency or utilize a platform that is moving, not digital currency but rather actual currency. And that's fine. That's fine. But this is a very positive step forward, I think. I think we're going to see that what Swift is doing is going to have significant importance over the next 10 to 15 years.
Well, thank you, Paul. You made some great points. Finally, I would like you to choose the biggest or the most important story of the past week and why.
Push, from my perspective, I'm going to go to some of the economic indicators that came out. Last week we had jobs report that was much more robust than what was anticipated. The Fed came out with a 50 basis point drop in the Fed funds rate. They came out bigger. I was anticipating they were going to do 25. That was me. But I knew there was a chance they would do 50. They went 50. I don't know if they regret that or not. History's going to tell. They might have been, maybe they had some buyer's remorse in there. And they're like, man, maybe we should have done 25. I don't know. I think this is going to be interesting for the next Fed rate decision. Obviously, we've got more economic data coming out before they meet and make a decision again. However, this is something that's slowing things down. So we're seeing bets out there in the markets that we're not going to have this soft landing right now. We still got too much growth out there. Inflation is still persistent. Jobs are still strong. So that's going to make the Fed potentially pause. So we'll see. We'll see. More economic indicators to determine whether that's going to be the case or not. But it's possible, I think. And that was not possible before that report. So I think that's the most important story.
Well, we've reached the conclusion of this episode. We're grateful for your valuable analysis and insights, Paul. Many thanks. We would also want to express our sincere appreciation to our CTM File audience for tuning into this edition of the Open Treasury podcast. Please subscribe to our podcast and check out the show notes for links to the articles discussed. Thank you and have a wonderful week. This podcast is provided for information purposes only, and statements made by CTM File or guests on this podcast are not intended as legal, business, or consulting advice. For more information, visit ctmfile.com.